When people think of inflation, they often think of the 70s. That's the default mental model that people have. And they also then, by definition, assume that high interest rates are the primary tool to combat high inflation. The problem materializes if you're trying to use the wrong tool for the wrong situation. So if the problem is you have very large federal deficits that's pouring more money into the economy, and you've done that long enough that you also have very high public debts as a percentage of GDP. The problem is that when you raise interest rates, well, if excessive bank lending wasn't the problem to begin with, it's only going to have a moderate effect on slowing down inflation.
Popular macro analyst and investment strategist Lyn Alden has warned that the Federal Reserve's seeming victory over inflation will only be temporary, and that there are lots of evidence suggesting that the United States is heading for an inflationary decade. During a recent interview, Alden discusses the current state of the U.S. economy, analyzing the possibility of a recession, a decade of higher and longer inflation, and the impact of rising interest rates and high debt to GDP ratio on the economy. According to the renowned macro analyst, the Federal Reserve is making a grave mistake in its fight to bring down inflation. Since March last year, the U.S. Federal Reserve has been jacking up interest rates to increase borrowing costs, thereby discouraging bank lending and reducing the amount of dollars in circulation. Alden explains that this is an appropriate tool for fighting inflation, but it's not effective for all causes of increased prices. She argues further that higher interest rates worked in the 70s because the increase in money supply was caused by increased bank lending. While rate hikes discourage bank lending, they do nothing for increased money printing, which is the cause of the decade's high inflation that started the Fed's hiking campaign in 2022. Alden further explains that not only is the Fed using the wrong tool to fight inflation, which would not provide a lasting solution to the problem, it could actually exacerbate the situation. What the economy needs, according to the macro analyst, is an austerity program, one that would result in a meaningful cut in Social Security, Medicare and Medicaid, and defense spending. However, Alden also admits that even an austerity program could further negatively impact the already fragile economy. During the 40s, the earliest period when the United States had a similar combination of a high debt to GDP ratio, explosive monetary supply, and high inflation, Alden explains that an austerity program was successful because interest rates were low, encouraging more investments, and as a result, increased tax payments and reduced debt expenses. The situation is very different now, as is the political environment. The result is a very dire outlook for the United States economy. We will now bring you some clips from Lyn Alden's recent interview with the Palisades Gold Radio. Please watch the video to the end, subscribe to the channel, and turn on post notifications for more videos like this. Also, ensure you drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and contributes to the channel's growth. Thanks, enjoy the video.
One of the tools that applies to both is trying to find ways to fix the supply side, right? So if there's a war, end the war, right? Or you complete the war one way or another. If there's an oil supply shortage, find a way to get those oil supply lines open, or find ways to incentivize more oil production. So basically fixing some of those bottlenecks or things that are damaging productivity is one that's always applicable. The other option, the other side of it, of course, is then addressing what is causing the elevated rate of money supply growth and how can you slow it down? And so if the answer is large fiscal deficits are responsible for the majority of money supply growth, then the answer is to reduce the deficit spending. Could be raising taxes, could be cutting spending. It depends on where the source of the problem is. But basically, that system needs to be less about financing deficits with money printing and more about sustainability. If the answer is elevated bank lending is causing it, then you want to find ways to slow down bank lending. And so that generally, that's where monetary policy tends to be more effective, by raising interest rates. So when people think of inflation, they often think of the 70s. That's the default mental model that people have. And they also then, by definition, assume that high interest rates are the primary tool to combat high inflation because it worked in the 70s. And the challenge there is that you have to kind of address what is the problem and what is your solution doing. So what exactly do high interest rates do? They do a couple things. One is, from a global funds flow perspective, they entice foreigners to want to hold your currency, and they entice locals to want to hold your currency, not go elsewhere, right? So if Turkish lira is inflating at 80% a year, but its interest rates are 20% a year, it's not desirable for either Turkish people or international people to hold it. And so Turkish people will try to get out of it. No foreigners will want to buy it, and the currency will weaken. Imports will get more expensive, and that's inflationary, right? So higher interest rates, or like higher real interest rates, help to entice people to want to hold that money. So that's number one. Number two is higher interest rates can slow down bank lending because it makes it less attractive for borrowers to borrow money. Um, Now, there's not a perfect correlation there. In fact, if you get too low interest rates, you can ironically slow down bank lending because banks don't want to lend because they're not compensated to it. The risk is too much relative to their gains. So it's not a linear perspective. But in general, if you have an inflationary environment, higher interest rates are one of the tools available to try to slow down that bank lending. The problem is that when you raise interest rates, well, if excessive bank lending wasn't the problem to begin with, it's only going to have a moderate effect on slowing down inflation because bank lending wasn't the source of most of the new money supply creation anyway in that particular environment. And two, it's actually going to increase the federal deficits because that 130% debt to GDP is now paying much, much higher interest rates, which flows into the private sector, right? That's flowing into retirees' bank accounts. That's flowing into um, you know, banks and insurance companies. That's flowing into offshore where they can buy more commodities with it. Basically, this is a much larger deficit situation. And so the challenge is basically using the wrong tool for the wrong job, or trying to basically address a problem by suppressing something else. So the reason that even the wrong tool can work sometimes is if you have a private sector money creation and a public sector money creation, and the public sector is causing too much of it, and you raise rates, well, depending on how the timing works out, it might work for a period of time because you could suppress private sector to below normal so that it offsets some of the fact that public sector is above normal. But of course, that only works for a period of time. And so I think that's what we find ourselves in now. Basically, the 2020s are, and I've been arguing this since 2020, is that this whole period looks a lot more like the 1940s. We don't have excessive bank lending. Our bank lending rate is not above normal. But what's above normal, both pre-COVID and then during COVID and then post-COVID, is very large federal deficits and then very high public debt to GDP ratios, so that increases in interest rates in some ways do suppress inflation because they can slow down commercial real estate, they can slow down tech VC. They do put some downward pressure on inflation, but at the same time, they're also exacerbating the fiscal deficits, and therefore, after a period of absorption, they risk actually exacerbating inflation in the long run.
Delving further into historical analogs relating to the current economic conditions in the United States, Alden explains that the money supply growth and deficits at the peak of the World War were bigger than during the peak of the COVID-19 pandemic. However, unlike the 40s, there is no end in sight now. We are not waiting for the war to end and for everything to go back to normal. Yet the Treasury plans to issue trillions of dollars in debt before the end year ends. Something has to give, and according to Alden, all the likely options will only further hurt the economy. An example is going austere to control the money supply and lift the economy out of the deadly debt spiral in which it is almost fully wedged. However, Alden explains that trying to get more austere could be self-defeating, as it could hurt the government's tax base by discouraging economic growth and expansion. Here are more clips from the interview as Alden further discusses the impact of higher interest rates on the economy with a federal debt that is over 100% of GDP.
So in the 1970s, you had federal debt as 30% of GDP. And most of the money creation was from bank lending. So by increasing interest rates, although it does increase the federal interest expense and deficits, the negative impact to bank lending is bigger, right? And so that is generally disinflationary. The problem is that if bank lending is like moderate or mild, and federal debt is 130% of GDP, the challenge is that beyond a certain point, as you raise interest rates, while it does put some downward pressure on bank lending, and that's disinflationary, the impact to that 130% debt to GDP is larger than that negative impact you're having on bank lending. And we can even go a step further and say, okay, well, look at Japan. Japan's like 250% debt to GDP, and bank lending's negligible. So if you raise interest rates, you're not going to impact bank lending that much, but you're going to completely blow out the deficit. And so as you kind of go along this road, money's like interest rates started having unintended consequences. So when we're in an environment like the 1970s with low federal debt to GDP and a lot of bank lending, money supply and interest rates work intuitively. Basically, they work how we imagine them to. You raise interest rates, it slows down bank lending, it slows down inflation, makes sense. When you have that inverse situation where so much debt is accumulated at the public level and deficits are not controlled, you've gone through the looking glass. You're like everything's flipped upside down, everything's reversed. And so raising interest rates can actually have unintended consequences, and beyond a certain point is either neutral for inflation, like it might have equal negative impact on inflation versus inflating something else. And if you get as extreme as, say, Japan, then it can outright be more inflationary. And another thing to consider is to what extent a society has locked in fixed long-term interest rates. So, for example, in the United States, during this low interest rate environment, homeowners locked in 30-year fixed rate mortgages. Corporations locked in very long duration, low fixed rate debt. And so let's take an example like ExxonMobil. ExxonMobil has a great credit rating, so they've been able to borrow very cheaply and at very long durations. They have, rough numbers, say 40 billion in debt and 30 billion in cash, right? But ironically, that cash is higher yielding than their debt now. They've almost like made themselves a bank in addition to an oil company, where they've issued all these like liabilities. Their liabilities are only rolling over. They're maturing and having to get refinanced at very low rates. So even though the higher interest rates are maybe not great for them, it's really not that impactful. Whereas it's impacting the federal government a lot more. It's shorter duration debt on average. And of course, it impacts interest rate sensitive areas significantly. So commercial real estate, that's also short duration debt. So that is, it's deflationary for commercial real estate. It's having that consequence. It negatively impacts junk rated companies because again, lots of debt, short duration. So they run into that financing risk. So the higher rates, it's not to say that it's not impacting things. It's impacting certain parts of the market, but it's almost like you have two different markets now. You have companies that really don't care about interest rates and companies that do. And then also for the consumer, I mean, if you, let's say you're a 65-year-old upper middle class retiree, right? And you've either got a house paid off or you've got a lingering fixed rate mortgage that you've locked in, and your bonds are paying a higher interest rate now. So you're going to go out and eat. You're going to go travel. You're going to spend on these things. That's why we see a lot of strength out of the services sector, because this increased money is pouring into the wealthy, the upper middle class, and kind of going down there. And so things that they buy are still doing pretty well.
According to recent reports, the market is pricing a higher probability that the Fed has ended its aggressive rate hike campaign. Several experts and analysts have also predicted that the central bank will need to start cutting rates as early as the first quarter of 2024. However, Fed officials continue to insist that interest rates will remain higher for longer to ensure that all traces of inflation are gone. Do you agree that we are heading for a decade of sticky inflation? How do you think that will impact prices in the short and long term? Please drop your replies as well as thoughts on Lyn Alden's outlook on the U.S. economy in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos. You can also check out our other videos featuring interviews from Lyn Alden and other expert analysts and prominent investors. Thanks for watching.